Hey there, awesome accounting student. Mark Franke here. This is a video for Accounting 100, Chapter 13. And in this video, we're going to prepare a multiple step income statement. This is an income statement that would be appropriate for a merchandising company, a company that sells a product. This is in your book. This is problem 13 2B in your book on page 471 and 472. So in this video, we're going to focus on the income statement, and then I'll do another video that will focus on the statement of owner's equity and the balance sheet. So with a merchandising company, the most important thing to remember here is that we have a split in this income statement, and we have something called gross profit. Gross profit is sales or revenue minus cost of goods sold. In other words, operating revenue is how much we sold, and cost of goods sold is what was our cost of those sales. So let's get started. The first step, of course, and the trial balance, I have prepared a trial balance from what's in the book, but all of these numbers are in your book. I've just put them in my spreadsheet here. So I've got a trial balance that totals up to $1,011,317. Debits equal credits, that's important. And so we're going to use this trial balance to prepare our statements, the first of which is the income statement. So the first step with any income statement is to prepare a heading. The name of the company is Hog Wild. This is an income statement, and it's for the year ended December 31, 2021. Always start with revenue, and in a merchandising company, that's called sales. Sales is 608,417 with a dollar sign. But we also had some sales returns. So we're going to say less sales returns and allowances. And that is $9,400. So our net sales is $599,017. We didn't have any sales discounts. If we did, we would include them as well. They would subtract out from sales to get net sales. But in this particular case, we don't have any sales discounts. Now, cost of goods sold. We are going to start with beginning merchandise inventory. Merchandise inventory $88,980. Now, by the way, I know I didn't provide you with any work papers in this particular thing because I think it's important. Start with a blank piece of paper. If you have to pause the video, I type fairly quickly, but we're going to go through this. But if you have to pause the video to catch up, okay, fine. But putting this down with pencil and paper is really, really a good practice for learning how to do it, right? If I gave you a work paper where you're just filling in numbers in boxes, you would not learn as much. And so it's the old no pain, no gain. This is going to take a little bit of time, and your hand may get a little tired, but it's really, really good practice for you to write this out on a blank piece of paper. I have put this income statement side by side because it fits better in my Excel spreadsheet to present to you. But I would just start at the top of a piece of paper, put the heading in, and just work your way down as we go. So if you need to stop or pause the video in order to get your work paper set up, go ahead and do that. But we'll just work through this at a decent pace. Now, Next, we have purchases. This is what we bought. And our purchases are $230,050. We also paid for some freight. Freight in. This is what we paid to bring this material into our warehouse, into our store, whatever it is that we're doing. In Hogwild, did they tell us what they do? Retail firm, and they sell motorcycles, parts, and accessories. So this is a motorcycle company. This is called delivered cost of purchases. In other words, what we paid for the material, the motorcycles, the leathers, the whatever accessories they have. And so we've got delivered cost of purchases of $239,650. We also had some purchase returns and purchase discounts. So I'm going to say less purchases returns and allowances. This is what we returned to our vendors and or took an allowance on. If they sent us something that we didn't like, they may have said, okay, go ahead and take a discount, whatever it is. That would be an allowance. But we also have some purchases discounts. As we learned back in our previous chapters, these are discounts we get when we pay early. So we've got a total purchases, returns, and purchase discounts of $12,180. When we subtract that from the delivered cost of purchases, we get net purchases of the $239,650 minus the $12,180, $227,470. $227,470. When we add that to what we had at the beginning, which is the merchandise inventory, we get what's called cost of goods available for sale. Cost of goods available for sale. In other words, what we had at the beginning plus what we bought during the year. That's cost of goods available for sale. $316,450. But we're not trying to find out the cost of the goods that were available for sale. We're trying to get the cost of the goods that we actually did sell. So, in order to get the cost of goods that we sold, we have to subtract the cost we didn't sell. And the cost we didn't sell is ending inventory. How do we know we didn't sell it? We still got it. And by the way, I'm going to draw a line here because I did a math function. Okay, so I've got cost of goods available for sale. And just to fix this, because it shouldn't have a line here, and I should have a line here. So I'm going to make that look a little better. Okay, good. So now we're going to take less ending merchandise inventory. It'd probably be a good idea if up here, if we say merchandise inventory at the beginning, or beginning merchandise inventory. That way somebody won't confuse it with the ending merchandise inventory. And the ending merchandise inventory is $87,915. $87,915. We're subtracting our ending inventory from cost of goods available, and that's going to give us cost of goods sold. Otherwise, known as COGS, cost of goods sold. Now, if we if we take the goods available and subtract the ending inventory, we get cost of goods sold. This is what it cost us for the motorcycles and accessories that we sold, which means our gross profit is sales, net sales, minus cost of goods sold, gross profit, 374.82. And I am going to take gross profit percent which is gross profit divided by net sales. So gross profit is the 374.82. Net sales is the 599.071. When we divide this out, I get a percentage of 62%. Actually 61.8%. I'm going to put a box around it. What does that mean? That means that this is the gross profit percentage. For every dollar of sales of our motorcycle stuff, we make roughly 62 cents in gross profit. Apple Computers is around 40%. Costco is around 17%. Walmart is about 30%. Target is about 30%. So this is a very healthy gross profit for our motorcycle company. And now the only thing we need to do now is just basically subtract all the expenses. And we're going to put them into three categories: warehouse expenses, selling expenses, and general administrative expenses. Our warehouse expenses are warehouse wages, warehouse supplies, and depreciation on the warehouse equipment. And those numbers are 64,300, 4,300, and 2,400. So those total up for our warehouse to 71,000. Selling expenses. We have our sales salaries, which is 78,900. We have some travel expenses for salespeople to go out and visit customers, 21,000. And we have delivery expense. Sometimes that's called freight out. But whenever we have to take product to a customer, it is a selling expense. 135,300 is our selling expense total. Then we have a bunch of general administrative expenses. Again, if you want to pause the video and write these out, or if you abbreviate them, it's not the end of the world, but it's not a good practice. But I'm going to go ahead and plug these in. 57,500 is salary expense for the office. 1,360 is office supplies expense. Insurance, 9,500. Utilities is 6,912. Telephone expense, 4,370. Payroll taxes, 19,200. Building repairs expense, 3,100. Property tax expense, 11,700. Uncollectible accounts expense, that's for our bad debts, 2,900. Depreciation on the building is 3,200. and depreciation on the office equipment is $1680. Of course, these things come from the adjustments that we made. And we'll total that up, and the total for the general administrative expenses is $121,422. All I did is just list them out and total them up. So when we total up our three different categories of expenses, warehouse expenses, selling expenses, and administrative expenses, $327,722. If we subtract that from gross profit minus these expenses, we're going to get our operating income. $42,760 is operating income for Hog Wild. Then we have some other types of things. Typically, we would put interest and taxes down below here. We don't have any tax expense, but we do have some interest income, some interest expense. These are not operating things, so that's why we put them here. Oh, in fact, I'm going to move these down one, sorry, because I want to label them as other income and expense. So we have interest income of $720. We have interest expense of $3,600. So that total other income and expense, $2,880. So our net income, which is operating income minus the other expense, $39,880. $39,880 is our net income for Hog Wild. Practice this. Very, very important statement for a merchandising company. Okay, that's it for this video. I'll have another video right after this that is to prepare the statement of owner's equity and the classified balance sheet. Thanks for listening, and I'll see you again soon.